Hello everyone, Ken AG here, and today I need you to see something that changes the conversation completely. Small silver coins in India, priced at the equivalent of $170 per ounce, while Western paper markets quote $106, Shanghai physical at $127, India's exchange at $121. Same metal, four completely different prices depending on where you are and what form you're buying. Not a rumor, not a tweet, a receipt, an actual retail listing from a major physical market. And when I walk you through the math, when I show you what this pricing behavior means for the global silver market, you'll understand why the disconnect between paper and physical is not closing. It's widening. This is not hype, this is documentation. And by the end of this breakdown, you'll have a framework for tracking whether this pricing anomaly spreads or whether it's just noise. Disclaimer. This is not financial advice. This is market structure education and macro analysis. I'm not telling you to buy or sell anything. Do your own research and consult qualified professionals before making investment decisions. Before we go any further, quick checkpoint. If this is useful, subscribe. Around 82% of people watching aren't subscribed, and that's wild because these updates move fast. Let's start with the proof, because proof is the only thing that matters when everyone's got an opinion but nobody's showing receipts. I'm looking at a retail listing from India, a verified precious metals dealer, not some random seller, not a gray market transaction, a legitimate business posting prices for immediate purchase. Here's what the listing shows. A 10-gram silver coin, 999 purity, standard bullion product, listed at 4,916 rupees. Now let me walk you through the conversion step by step, so you can verify this yourself. Because when someone tells you silver is trading at 170, you should demand the math. 10 grams of silver equals 0.3215 troy ounces. That's the standard conversion. Troy ounces are what we use to price precious metals globally. So, when we see a price per gram, we convert it to price per troy ounce to compare it to the spot quote. 4,916 rupees divided by 0.3215 troy ounces equals approximately 15,300 rupees per troy ounce. Now we convert rupees to dollars. The exchange rate fluctuates, but at the current rate of roughly 90 rupees per dollar, 15,300 rupees equals approximately $170 per troy ounce. $170 for a standard 10-gram silver coin, while Western paper markets quote 106. But before we dive deeper into this Indian retail pricing, let me give you the full global picture. Because what we're seeing is not just India being expensive, we're seeing market fragmentation across the entire planet. Western paper markets, COMEX, $106. Shanghai physical delivery, $127. India's multi-commodity exchange, $121. And Indian retail for small coins, $170. That's a spread from 106 to 170. That's a $64 range for the same ounce of silver, depending on where you are and what size you're buying. In percentage terms, the retail premium in India is 60% over Western paper. Shanghai physical is 20% over Western paper. India's exchange is 14% over Western paper. Now, before you say, wait, that's a small coin. Small coins always carry higher premiums. Let me show you the larger bar pricing from the same dealer. A 1 kilogram silver bar, 999 purity, 1,000 grams, listed at 395,485 rupees. 1 kilogram equals 32.15 troy ounces. So we divide 395,485 by 32.15, and we get approximately 12,300 rupees per troy ounce. Convert that to dollars at 90 rupees per dollar, and you get roughly $137 per ounce. $137 for the large bar, $170 for the small coin. Notice the pattern. The small unit price is higher per ounce than the large bar because small units carry fabrication premiums, distribution costs, and a scarcity premium for immediate availability. That's normal market behavior. But here's what's not normal. The base price, the floor, Even the large bar, the product that should price closest to spot, is trading at $137. That's a 29% premium over the $106 Western paper quote. And it's right in line with what Shanghai is paying for physical at $127. India's official exchange is at $121. So the wholesale bar pricing in India is tracking somewhere between the exchange price and the Shanghai physical price. 29% premium on a kilogram bar. That's not a retail markup. That's a replacement cost signal. That's the Indian market saying, we can't source silver at 106. The real cost is 120 to 137, depending on what we're buying. So let me be precise about what I'm showing you here. I am not saying every dealer in India is pricing silver at 170 across the board. I am not saying the entire Indian wholesale market has moved to triple-digit dollar pricing universally. What I am showing you is this. Real retail pricing in a major physical market is behaving like the Western paper quote is optional. Like the $106 spot price is a suggestion, not a command. India's own exchange is at 121. Shanghai physical is at 127. These are not isolated incidents. These are multiple markets, multiple price discovery mechanisms, all saying the same thing. Physical silver costs more than Western paper quotes. And when physical markets start ignoring paper prices across multiple regions, that's not a premium story anymore. That's a structural shift. That's the global pricing system fragmenting in real time. Let's talk about why India matters. Because some people will look at this data and say, okay, fine, India's paying more. So what? India always pays premiums. That's a local market quirk. Wrong. India is not a quirk. India is a signal. India imports roughly 6,000 tons of silver per year. That's approximately 193 million ounces. That makes India one of the top 3 physical silver buyers on the planet. This is not a speculative market. This is not a derivatives market. India does not trade silver futures for fun. India buys physical metal. They take delivery. They hold it. They convert it into jewelry, into coins, into bars that sit in homes and vaults as wealth preservation. In many parts of India, metal is not a theory. It's culture. It's tradition. It's how families store value across generations. When you don't trust the banking system completely, when currency has a history of devaluation, so when a culture that buys nearly 200 million ounces of physical silver per year starts paying triple-digit dollar prices while Western paper markets quote 106, it's telling you something uncomfortable. And it's not just India. Shanghai, the heart of the world's manufacturing economy, is paying 127 for physical. That's a $20 premium over Western paper. India's official exchange, where actual trades clear, is at 121. That's a $15 premium. These aren't retail markups. These are wholesale clearing prices in the 2 largest physical silver markets on the planet. The paper price is losing authority. Not everywhere, not overnight, but region by region, market by market, quietly, physically. This is how resets start, not with a headline, not with an announcement from the Federal Reserve or the COMEX. It starts locally, one market at a time. One region says, we're not accepting your price anymore. We're paying what it actually costs to source the metal. And then another region follows, and another. And eventually, the paper quote becomes what it always was, a fiction maintained by leverage and liquidity until physical demand calls the bluff. Now let's break down the mechanism. Why is this happening? Why can't arbitrage close this gap? In a normal market, when you see silver priced at 127 in Shanghai, 121 on India's exchange, 137 for Indian retail bars, and 106 in New York, arbitrageurs should jump in. They should buy in New York, ship to Asia, sell at the higher prices, pocket the difference. That arbitrage activity should compress the spread until prices equalize. But that's not happening. The gap is persisting, In some cases, it's widening. Why? 3 reasons, and these reasons explain why this disconnect can persist far longer than people expect. Reason 3. Trust is breaking. Arbitrage assumes both prices are real. But what if the $106 Western paper quote is just a number on a screen representing a contract that might not actually settle in physical metal? What if the $127 Shanghai price, the $121 India exchange price, the $137 Indian bar price are the real prices, because that's what it costs to get metal you can actually hold? When paper and physical decouple across multiple regions simultaneously, arbitrage doesn't close the gap. Arbitrage exposes the gap. It reveals which price is real and which price is a derivative abstraction. Let me explain this mechanism more carefully, because this is where most people get confused. They think if there's a price difference, someone will arbitrage it away. But arbitrage requires certain conditions. You need available supply at the cheap price. You need reliable transportation. You need trust that both sides of the trade will settle. And you need the time horizon to match the logistics. In the current silver market, none of those conditions are fully met. The COMEX has silver, but most of it is not in the registered category, available for immediate delivery. It's in the eligible category, which means it's stored in COMEX vaults, but not specifically allocated for delivery against futures contracts. The owners of that eligible silver can choose to move it to registered if they want, but they don't have to. So the visible available supply is much smaller than the total vault holdings. Shipping physical silver internationally is not instant. You need to arrange transport, get insurance, clear customs, pay import duties, handle currency exchange. The entire process can take weeks. And during those weeks, prices can move. The arbitrage opportunity that looked profitable when you started might be gone by the time your metal arrives. That's execution risk. That's why simple price differences don't always get arbitraged away immediately. And here's the trust issue. When you buy a COMEX futures contract at $106, you're buying a promise that if you hold that contract to delivery month and stand for delivery, you'll receive physical silver. But what if the counterparty doesn't have the silver? What if they settle in cash instead? What if they default? The contract says you get silver, but contracts can be changed. Rules can be altered. We've seen exchanges suspend trading, cancel trades, and change settlement terms when physical delivery stress gets too intense. So when Shanghai buyers pay $127 for physical metal in hand today, when Indian buyers pay $121 on their exchange and $137 for bars, versus $106 for a COMEX paper promise that settles in 3 months, they're not being stupid. They're pricing in counterparty risk. They're pricing in delivery risk. They're pricing in the possibility that the paper promise might not actually deliver metal when it matters. That's the trust breakdown. And once trust breaks, arbitrage stops working the way textbooks say it should. We've seen this pattern before, not just in silver. In every market where paper claims vastly exceed physical availability. In 2021, nickel on the London Metal Exchange spiked 250% in 2 days because a large short position couldn't deliver physical metal. The exchange suspended trading, canceled trades, changed the rules retroactively. In 2020, during COVID, paper silver hit $28 per ounce, but physical coins and bars were selling for $45, 60% premium. The disconnect lasted months because mints couldn't produce fast enough. Dealers were backordered. Today's situation rhymes with that period, but with critical differences. In 1980, the Hunts were leveraged speculators. They could be forced to liquidate. Today, the buyers are sovereign nations. China buying for strategic reserves. India buying for cultural wealth preservation. Industrial manufacturers buying for production needs. You can't margin call a country. You can't force a solar panel manufacturer to stop buying silver because they need it to make their product. And here's another historical parallel. In 2011, Silver ran from $18 to $49 in 6 months. The rally was driven by investment demand, by fears about currency debasement, by the aftermath of the financial crisis. When it peaked at 49, COMEX raised margins 5 times in 8 days. The price crashed to $26. The manipulation worked. The paper market controlled the price. But notice what's different now. In 2011, when COMEX raised margins and the price crashed, it stayed down. The crash stuck. Physical buyers didn't step in because there was plenty of physical available. The vaults were full. Industrial demand was moderate. The crash was allowed to persist. In 2026, when COMEX raises margins and the price dips, it recovers within hours. Why? Because physical buyers are waiting. When paper traders panic and dump contracts, physical buyers step in. They drain the vaults. They take delivery. They convert paper selling into physical buying. The manipulation doesn't stick anymore because the physical market has taken control. That's the fundamental difference between now and every previous silver rally. Previous rallies were driven by speculation, paper buyers chasing momentum. When the rules changed, when margins increased, when selling pressure hit, the speculators folded. This rally is different. This rally is driven by physical demand from buyers who cannot be forced to sell. Now we're seeing it again. But this time, it's not panic buying. This time, it's structural. The deficit is real. The inventory is draining. And major physical markets are repricing accordingly. So, what do we watch for next? What are the signals that tell us whether this India pricing is an isolated anomaly or the beginning of a broader repricing? Signal 1. Geographic spread. If triple-digit local pricing shows up only in India and nowhere else, it could be regional factors, import duties, currency stress, local supply chain issues. But if we start seeing similar pricing in Indonesia, in Vietnam, in Thailand, in other major Asian physical markets, that's confirmation. That tells you the repricing is not local, it's systemic. Signal 2. Product availability. Watch the listings. Are bars and coins moving to made-to-order status? Are delivery times extending? Are dealers limiting quantities per customer? When availability becomes the constraint, price becomes secondary. You pay whatever it takes to secure the metal. Signal 3. Premium persistence. Premiums can spike temporarily during panic or supply shocks. But if the 50 to 70% premiums we're seeing in India persist for weeks or months, that's not a spike. That's a new baseline. That tells you the market has fundamentally repriced and the paper quote hasn't caught up yet. Signal 4. Arbitrage failure. If the gap stays wide despite obvious profit opportunities, it confirms the bottleneck. It confirms that physical is not freely available at the paper price. And when arbitrage fails, the cheaper price is the fake price. Now let's talk about what this means for the broader silver market. Because India is not the whole story. India is one data point, but it's a data point that fits into a larger pattern that's been building for years. The COMEX registered silver inventory. That's the metal available for immediate delivery to settle futures contracts. It's currently sitting around 26 million ounces. That's down from over 100 million ounces just a few years ago. 74% decline. The London vaults. The LBMA stores physical silver for institutions, ETFs, and large buyers. Those vaults have been draining. Reports indicate 5 to 8 million ounces per week leaving London, heading east, to China, to India, to physical buyers who want metal, not paper promises. The Shanghai premium. Silver trades on the Shanghai Gold Exchange at prices consistently above Western benchmarks. When Shanghai prices silver higher, it means Chinese buyers are willing to pay more for physical delivery than Western derivative traders are pricing the futures contracts. That's a signal. That's demand exceeding supply in the world's largest manufacturing economy. The U.S. Mint, the official mint of the United States. They sell American silver eagles, the most popular silver coin in the world. Last year, they couldn't keep up with demand. This year, they're rationing sales. And when you look at their pricing, their premiums over spot have exploded. not because of numismatic value, because of replacement cost, because sourcing the silver blanks to make those coins is getting harder and more expensive, regardless of what the COMEX ticker says. All of these data points fit together. They tell a story. And the story is this: the physical silver market is tightening. Supply is constrained. Demand is structural, not speculative. Industrial use is at record highs because of solar panels, because of electric vehicles, because of electronics that require silver's unique conductivity. Investment demand is rising because of currency concerns, because of geopolitical instability, because people want hard assets in uncertain times. Let me break down the industrial demand side more specifically, because this is where the structural deficit becomes undeniable. Solar panels are the single largest growth driver for silver demand. Each solar panel requires approximately 20 grams of silver. That doesn't sound like much until you multiply it by billions of panels. Global solar installations are projected to continue growing at double-digit rates for years because of climate policies, because of energy security concerns, because solar has become cost competitive with fossil fuels in many regions. The International Energy Agency projects that solar capacity will triple by 2030. If that happens, silver demand for solar applications alone could reach 300 million ounces annually. That's nearly 1/3 of total annual mine supply, and that's just one industrial application. Electric vehicles use more silver than traditional combustion engine vehicles. The electrical systems, the battery management, the charging infrastructure, all of it requires silver. As EV adoption accelerates, as countries ban combustion engines, as the transportation sector electrifies, silver demand from automotive applications grows. Now combine that inelastic industrial demand with investment demand from stackers, from funds, from institutions, from sovereign nations, and then add in the supply-side reality that mine production is relatively flat, that most silver comes as a byproduct of copper, lead, and zinc mining, that you can't just ramp up silver production quickly because it's tied to base metal production, and that recycling, while helpful, only covers about 15 to 20% of annual demand. When you put all those pieces together, the math is simple. Demand exceeds supply, the deficit is structural, and the deficit is growing. The Silver Institute estimates the supply deficit for 2025 at over 150 million ounces. That's not a small gap. That's 15% of total annual mine supply. And that gap has to be filled from somewhere. It's being filled by draining inventories, COMEX vaults, London vaults, ETF holdings. Above-ground stocks are being depleted to meet current demand. But those stocks are finite. Eventually, they run out. And when they run out, the only way to balance the market is through price. And the paper market, the futures contracts, the ETFs, the derivatives that are supposed to represent silver, they're not backed one-to-one by physical metal. The leverage is enormous. The claims on each ounce of real silver are multiples of the actual metal. When that leverage unwinds, when delivery demands exceed available inventory, when trust in paper promises breaks, the adjustment is not gradual. It's not orderly. It's forced. It's fast. And it's repricing events like we're seeing in India that give us early warning. So let me address the counterarguments, because if you're thinking critically about this, you should be skeptical. You should question the data. You should ask what I might be missing. Counterargument 1. India has high import duties on silver. That's why prices are higher. It's taxes, not market repricing. True. India does have import duties, currently around 6%. But 6% doesn't explain a 29% premium on bars or a 60% premium on small coins. 6% import duty on a $106 spot price adds $636. That brings the landed cost to $112.36, not $137, and certainly not $170. The gap is way beyond tax. And here's the critical point. India's official exchange, the MCX, is quoting 121. That's after import duties are factored in. That's the legitimate wholesale clearing price, and it's still $15 above Western paper. Shanghai Physical at 127 is $21 above. These aren't tax artifacts. These are real physical premiums. Counterargument 2. These are retail prices. Retail always carries markup. You're comparing retail to wholesale spot. That's apples to oranges. Fair point. Retail does carry markup. Typically, bullion dealers charge 2 to 5% over spot for standard products, maybe 10% for small coins. But we're seeing 29% premiums on wholesale bars and 60% on small retail coins. That's not normal markup. And more importantly, it's not just retail. India's multi-commodity exchange, where institutional players trade, is at 121. That's 14% above Western paper. Shanghai physical delivery, not retail, but wholesale physical settlement, is at 127. That's 20% above Western paper. The disconnect exists at every level of the market, from exchange trading to wholesale bars to retail coins. Counterargument 3. Currency weakness. The rupee is under pressure. That's inflating the local price when converted to dollars. Possible. Currency fluctuations do affect local pricing. But here's the thing. If it was purely currency, we'd see similar patterns in other rupee-denominated commodities. We'd see gold showing the same massive premium, but gold premiums in India are much smaller, 5 to 10% over spot, not 29 to 60%. Silver is behaving differently because silver supply is tighter, and currency doesn't explain Shanghai. China's yuan is not collapsing, yet Shanghai physical is at 127, 20% above Western paper. The premium exists across multiple currencies, multiple regions. That tells you it's not a currency issue, it's a physical availability issue. Counterargument 4. This is one screenshot, one dealer, one moment in time. You can't extrapolate a global repricing from a single data point. So, here's my framework for what comes next. This is not advice. This is not a prediction. This is a tracking framework, so you can monitor whether this India pricing is a leading indicator or a false alarm. Watch for confirmation in other Asian markets. If Indonesia, Thailand, Vietnam, Malaysia start showing similar premiums at the exchange and retail level, that's geographic confirmation. That tells you this is not just India, it's regional demand exceeding supply across Asia. Watch for premium persistence over time. Track not just Indian retail, but India's MCX exchange prices, Shanghai physical prices, and compare all of them to Western paper. Pull up dealer sites weekly, track the spreads. If the $15 to $20 premiums at the exchange level persist for weeks or months, that's not a spike. That's the new baseline. That's official price discovery saying Western paper is wrong. Watch for Shanghai's lead. Shanghai is the world's largest manufacturing economy. If their physical premium over Western paper widens from $20 to $30 to $40, that's industrial buyers panicking. That's the signal that real economic actors need metal and will pay whatever it takes. Watch for product availability changes. When listings switch from in-stock to pre-order, when delivery times extend from 2 days to 2 weeks, when dealers start limiting quantities, those are friction signals. Those tell you the metal is not flowing freely at the stated price. Watch for arbitrage opportunities that don't get taken. If you can theoretically buy silver at 106 in New York and sell at 121 on India's exchange or 127 in Shanghai, but nobody's doing it at scale, ask why. The answer is usually, you can't actually source the metal at 106. The 106 is a quote, not an offer. Or the metal exists but can't be moved fast enough. Or the cost and risk of the trade eliminate the profit. Watch for official responses. If this disconnect becomes undeniable, if it starts affecting industrial supply chains, if manufacturers can't source silver at paper prices, there will be official responses. Maybe COMEX changes margin requirements. Maybe they adjust delivery rules. Maybe exchanges suspend trading like they did with nickel. And watch for narrative shifts. When mainstream financial media starts talking about silver shortages, when analysts start saying the paper market is broken, when the skeptics flip and start recommending physical, that's the late-stage signal. That's when the crowd moves, and by then, availability will be the constraint, not price. Now let me give you the stacker perspective. What does this mean if you're someone who buys physical silver, who holds ounces, who's trying to build a position? First, understand that paper price and physical price are diverging. The spot quote you see on financial websites is increasingly irrelevant. It represents futures contracts, derivatives, paper claims. The real price is what you pay to get metal in hand. And that real price is higher, sometimes much higher. Second, recognize that availability is becoming the bigger issue than price. You can always pay more to get metal, but if the metal isn't available at any price, if dealers are sold out, if mints are rationing, then the price becomes academic. You can't buy what doesn't exist. Third, accept that premiums are not coming down. For years, stackers waited for premiums to normalize. They thought, I'll wait until premiums drop back to $2 over spot. But premiums didn't drop. They rose because the structural deficit is real, because demand is outpacing supply, because the paper price is not reflecting physical reality. Fourth, stop timing the dip. I know it's tempting. You see Western paper at 106 and you think, maybe it drops to 100. I'll wait. But look at what physical markets are actually doing. Shanghai is at 127. India's exchange is at 121. While you're waiting for 100 in the West, physical buyers in Asia are paying 120 to 130. So even if Western paper drops to 100, your actual cost to buy physical might still be 120, because that's where physical clears. You're not saving money, you're losing availability. Fifth, prioritize immediate delivery over price. If you're buying from a dealer and they offer you two options, in-stock ships today at a higher price, or pre-order ships in 6 weeks at a lower price, take the in-stock. Because in 6 weeks, that pre-order might not ship. The dealer might cancel because they can't source the metal. And then you're back to square one, except now availability is even worse. Sixth, diversify your sources. Don't rely on one dealer. Don't rely on one product type. Spread your purchases across multiple dealers, multiple product types, multiple countries if possible. Because if one supply chain breaks, you have alternatives. And seventh, understand the end game. This disconnect between paper and physical cannot persist indefinitely. At some point, one of three things happens. Either paper price rises to meet physical price, or physical becomes unavailable and price becomes irrelevant, or the paper market breaks and trading gets suspended. None of those outcomes are good for people trying to buy silver at the last minute. The smart play, if you're building a position, is to prioritize securing the ounces while they're still available. Don't chase the perfect price. Chase the availability, because in a shortage, the guy with metal wins. The guy waiting for a better price ends up with nothing. Now let me close with what I'm tracking this week. Not predictions, just the next proofs I'm looking for. First, I'm watching for more India pricing data. If this $170 small coin pricing was an outlier, we'll see it normalize. Prices will drop back toward the exchange price of 121 plus normal retail markup. But if more dealers start posting similar extreme premiums, if the pattern repeats, that's confirmation that even with an exchange at 121, retail physical is so tight that dealers are charging $50 premiums on top. Second, I'm watching for similar patterns in other Asian markets. Indonesia is a big physical buyer. So is Thailand. If their retail pricing starts showing the same disconnect from Western paper, if their exchanges start pricing above COMEX like India's MCX already is, that's geographic spread. That tells you this is not local, it's structural. Third, I'm watching Shanghai premiums closely. Shanghai is already at 127, $21 above Western paper. If that gap widens to $30 to $40, if Shanghai starts paying 150 while the West still quotes 106, that's the industrial core of the world saying paper price is irrelevant. We need metal and we'll pay what it takes. Fourth, I'm watching COMEX registered inventory. If it drops below 20 million ounces, that's a red line. That's the point where delivery stress becomes acute, where the exchange might have to change rules to prevent a default. Fifth, I'm watching dealer availability in the US and Europe. If American Silver Eagles go to pre-order only, if Canadian Maples become hard to find, if European dealers start extending delivery times, that's confirmation that the tightness is not just in Asia. And if you understand the mechanism, if you track the signals, you'll see the endgame approaching long before the crowd panics. The endgame is simple. Either Western paper reprices upward to match physical reality in Asia, or the two-tier system becomes permanent. Screen silver versus delivery silver. And in that world, the 106 quote on your screen becomes trivia. What matters is whether you can actually get metal and what you have to pay when you do. If you want proof over hype, if you want receipts over speculation, subscribe to the channel. I'll be posting the pricing screenshots in the community tab here on YouTube. I'll be tracking these signals weekly, and when the next data point comes in, you'll see it here first. If you want proof over hype, if you want receipts over speculation, subscribe to the channel. I'll be posting the pricing screenshots in the community tab here on YouTube. I'll be tracking these signals weekly, and when the next data point comes in, you'll see it here first. Comment one thing. Have you seen physical silver pricing detach like this in your region? What premiums are you seeing locally? And if you're trying to buy, are you finding in stock availability, or are things moving to pre-order? I read every comment. I track every data point. Because this is not about being right. This is about documenting what's actually happening in real time. And when the history books write about the silver repricing of 2026, we'll have the receipts to prove we saw it coming. That's it. Stay sharp, track the proof, and I'll see you in the next one.